Housing waiting list across Zimbabwe.
Equity news on Equity Access, your cross-section of the stock markets and of developments in the Zimbabwean economy. A beautiful evening it is to you. Ibn Mabunda signing in. Let's get on to business. Our news tonight, ZSE listed properties concern Marsh Holdings today held an annual general meeting in the capital with the trading update being given by the managing director, Mr. Gibson Mapfidze. While Marsh Holdings is a properties firm which is heavily invested in residential accommodation but is also into commercial property, particularly retail, industrial, as well as other forms of commercial property. Of note, according to the trading update, is the fact that this update is for the 4 months to the 31st of January, and in the period the company registered a 7% growth in its revenue to $1.68 million. As well, their voids position improved from a 29% to 24%. Well, as I said, Mr. Gibson gives us the trade report. Let's have a listen.
In terms of our revenue, so as at 31 January 2019, it stood at 1.68 million, which was 7% above the same period last year. Then it was 1.58 million. But our revenue was 3% below budget. So I'll talk to that just now. So in terms of the upward movement compared to prior year, it's mainly because of the occupancy levels. So occupancy levels went up in Q4 of 2018 to 76%, up from 71% prior year. So that additional revenue helped us in terms of realizing that. The negative variance that you see, 3% against budget for current year, is because of the delays in selling the Rua Windsor Park stands. We are commencing selling those ones in April, that should correct going forward. We have also, so the numbers I've shared do not include the rent reviews. I'm just going to talk about them now. Our rent reviews were effective 1 February. So we have managed to review 75% of our portfolio effective 1 February and achieved a 58% revenue upliftment from 1 February to 30 April. So we've also reduced our rent review terms from 12 months to 3 months now, given the dynamics in the market. So the idea is to have an opportunity going forward to look at our rentals and review them on an ongoing basis. Then looking at our expenses, our property expenses for the 4 months stood at 311,000, and they were 23% lower than prior year. So the major contributions to that is the improvement in occupancies helped us in terms of tenants carrying the void cost that we were carrying last year for the marginal 5% increase. Then as well, our provisions for bad debts have gone down, and this is because we collected significant amounts from September to January 2019, so that has an impact on our provisioning as well. In terms of current collection, so we stand at 86%, and that explains our decrease in provision for bad debts. Then admin expenses, they have gone up 41% as compared to prior year, standing at 496,148 for the 4 months. And this is mainly because of price increases. So this is really inflation and also increase in staff costs after engagement of the new employees. Then moving on to our operating profit for the 4 months. So our operating profit we are reporting excludes fair value adjustments. So despite the delays in sales of the Rua Windsor Park stands, we realized a profit of 1.1 million, which is 47% higher than prior year, which stood at 655,000 and 22% above current year budget. So our operating profit margin, it went up to 62%, up from 45%. So going forward, we are embarking on optimizing our processes, internal processes, and we project that operating profit margin to further improve from 62%.
Just to have a quick look at the performance of the corporation dating back a few years. Well, these guys are coming from a trade negative, so to say. In 2016, they recorded losses of $5.94 million. In 2017, for the full year, their profit position scaled to 1.57, as well as 2018, $2.39 million. Well, in my conversation with the managing director, Mr. Gibson, he let us in on the strategy of the corporation going forward.
Going forward, we want to diversify our revenue streams. So we speak of the property management one, and we want to add to it third-party business, where we even manage properties on behalf of other corporate occupiers. We do project management, we do valuations, we do corporate real estate management. So those are other revenue streams that we would want to pursue. But looking at land development, yes, going forward, so our land development strategy is based on the fact that we have a total of 1.3 million housing waiting lists across Zimbabwe, and that points to a potential. Yes, here and there are issues to do with effective demand of those people listed on the various local authorities waiting list, but our duty is to look at how do we deliver stands and houses in an affordable way to ensure that we tap into that market. So yes, going forward, we have lined up land banks. We are engaging with local authorities to acquire suitable land for the development of both low-income and medium-income housing. So that should also add into our revenue going forward. We continue engaging with universities. We are very excited to participate in student accommodation. We have engaged with MSU, for instance, and the challenge we always find with student accommodation is where we want to build these structures on land that can be transferred in terms of if anything goes bad. So we have been engaging the universities, understand what we want to do. We would want to build on freehold, land with freehold title that attracts capital, and going forward we think we are going to participate, especially around UZ and MSU. We are already in engagement with these universities, and we're very happy to participate. Again, it's an area we think there's a need, and businesses exist to resolve or provide for a need. So going forward, yes, we would want to participate in student accommodation.
Meanwhile, SeedCo International Limited recently released its financials for the half year to 30 September 2018. Well, the corporation has a primary listing on the Botswana Stock Exchange as well as a secondary listing on the Zimbabwe Stock Exchange. Sounds familiar? Very much so. This corporation was unbundled by SeedCo Limited, which is listed on the Zimbabwe Stock Exchange. So the purpose of the unbundling of the corporation was to try and generate revenue for the operations of SeedCo across the continent. So what you have there is a situation where SeedCo Limited, which is listed on the ZSE, owns a 26% stake in SeedCo International. And now SeedCo International has a significant footprint across the continent. Let's just have a look at the footprint that it has across the continent. As you can see, it's there in Nigeria, Ethiopia, it's there down in South Africa, Zimbabwe, Mozambique, Botswana, moving right up into Central Africa and several countries around that territory. So this corporation has just had its first reporting after having been listed on the Botswana Stock Exchange on the 5th of October. With the listing, they were able to raise over $20 million in an attempt to expand the footprint of SeedCo across the continent. SeedCo's business is highly seasonal, with the bulk of its sales being recorded in the second half of the trading season. Resultantly, they reported a loss position of $3.3 million, which was of $1.5 million, which was an improvement from a net loss position of $3.3 million in the comparative period the last season. Hence, the losses that the corporation has actually reported. Now, according to the report, earnings are forecasted to grow, driven by improved seed supplies in Tanzania as well as Kenya. Well, then the report also mentions that in Zambia, there is the return of what is known as the Farmers Input and Support Program, which is expected to boost the operations with regards to the revenue performance of the corporation. In Ethiopia, efforts are still being made to secure the necessary licenses, despite the fact that the group is already operational in the country with some of its products. Moving on, Natfoods, well, they've just released their financials, and of note to the financials, despite the fact that we've reported on the performance, is the fact that the corporation has actually increased its contract farming hectarage over the past few years, coming from 2015, where the land under their contract farming scheme was 4,400 hectares, 2016 5.4, 6.8, and currently it's 10,400 hectares. Idea there being, since this corporation is actually into food processing, this is an attempt to secure supplies for the corporation going forward, hence the significant scale which has nearly doubled over the past 4 years. If we're to have a breakdown of the hectarage, this 10.4 that we have here, and how it is actually broken down, you realize that 9,500 hectares are broken into hectarage for maize, wheat, sugar beans, popcorn, as well as soybeans. Of course, of course, there is also the other 900 for soybeans, but the difference between the soybeans you have here against that is that over the smaller fraction, they're actually in a partnership with Pure Drop to secure soybeans there. But this hectarage that has maize as well as other products is specific just to the corporation in that sense. So this, as I said, is an attempt to secure the supplies of the corporation as they seek to expand their footprint across the country. Moving on to our next story, JSE-listed Standard Bank Africa cuts 1,200 jobs in South Africa with a pending move to eliminate over 91 branches in South Africa. Well, Standard Bank is Africa's second largest bank by number of by presence in the continent in that sense. Second only to Societe Generale, which has a presence in 32 countries. How is that relevant to Zimbabwe? Well, Standard Bank has a branch, has a presence in Zimbabwe under the name Stanbic. I'm sure you've seen this one. So with that, question is this move going to come to Zimbabwe? Well, this would be something worth noting, given the fact that they have 20 branches across the country with a workforce of over 650 permanent staff and about 100 who are non-permanent in that sense. So if that kind of move comes to Zimbabwe, well, that could potentially spell disaster. For conversation on these and other issues, I'm joined in studio by our resident chief analyst, Respect Gwenzi. Respect, good evening and welcome to the show.
Thank you, Eben. My pleasure. Good evening, viewers.
Beautiful. Let's get the ball rolling.
Sure.
Mash Holdings, they're giving us their trade update in terms of their performance and how they've improved their voice position as well as scale and revenue. Quite marked progress. But I want us to focus on the strategy that Gibson gave to us there, that they intend to tap into the student accommodation space. What is your take where that is concerned?
Yeah, MASH is a predominantly CBD office space. Its property portfolio is dominated by CBD offices. So that has not bode well with the company over the past few years as tenants migrate to suburban properties and also to the peripheries of the urban of the CBD areas. So that has led to a sharp decline in rentals, that is rental income from properties. If you see some of the big buildings in Harare, they are due to that respective property company. So in the recent years, they've now sought to diversify into other sectors. And one of those key sectors is student accommodation, which is basically residential, because it means if you're building a property where students can stay, it means it's a residential property. So they have now they will now want to tap into the backlog, into the country's backlog in terms of residential properties. And according to statistics, there's about a 1.2 million housing property backlog in Zimbabwe, and most varsities have not acquired allocations from government to build infrastructure to accommodate the surging numbers of varsity goers lately. So that has been an opportunity for not only MASH but the general property companies operating in Zimbabwe. A recent one being ZPI, which also used to be predominantly CBD office dominated portfolio, and lately they've built infrastructure for students at NAST in Bulawayo. So that's the same path which MASH wants to take to also tap into that sector. So presently there has been about a 20% occupancy levels, although in fact occupancy levels have grown lately, but void levels have also been high, and this is mainly due to the lack of enough occupancies at most of its CBD offices. So this has now driven them to want to explore in other areas, which include residential properties. So MASH has not had any representation within the hospitality property sector, which is a place that has been dominated by Dawn, which owns all the hotels that are operated by African Sun. And so there has been a lot of demand, both from a tourism perspective and in terms of also properties in resort. In resort spaces like Victoria Falls. There's been a huge demand, and the number of rooms in that resort town is below demand. So they've found scope in tourism, in the tourism sector, where they now wish to play a bigger role. So they're looking for other opportunities as they go, but presently they have managed to locate one of their hotel, which is one of their properties in Harare, which is the Charter House, which they now want to convert into an 80-room hotel through a partnership with a Chinese investor, bringing in about 20 million. The investor has already presence already in the tourism space, so they want to explore more opportunities within that space. Compounded to that as well is the scope which you highlighted. Now that they want to play in residential, in offering student accommodation, what does it mean as part of the strategy? Right. So they've identified that there's deficit mainly in tertiary schools, where students don't have ready accommodation within or close to campus or confined to the campuses. So they want to play in that space, offering tertiary accommodation, which is also which is also a sector that has not had significant investment.
Okay, moving on to talk about SeedCo International, which released its financial results for the half year to 30 September 2019. Of note, there is their net loss position of $1.5 billion. What is the significance of that?
There's been significant expansion projects that were undertaken by SeedCo International. Part of the capital commitment that was made to the entity has been used in furthering part of their investments across Africa, and obviously that increases the expense side of things. But also worth noting is that the first half is typically a cost accumulation period due to the cyclical nature of the products that they of the field that they play in. If you are doing maize, you know that people plant in the second half of the year, and so they usually so usually there are no purchases at the beginning of the year or right at the end of the year. So people start purchasing as we get into the second half. So we'll see that loss being overturned as we get into the second half of the year. But it's quite paramount to highlight that much of the costs have also been driven by administrative costs and costs of acquiring and also research and development of which particular seed is okay for different markets, be it Kenya and so forth. You'd want to have a particular seed that is compatible with the soils in that respective country. So there has been some commitments towards research and development, and there's also been acquisition costs and so many partnerships that they're getting into. But essentially that loss position should be overturned by the second half.
Okay, talking about still on SeedCo, but talking about how they have been able to, penetrate some of the territories. Of note from the report was the fact that they have expressed that they're looking for licenses in Ethiopia, and they've also indicated new products for Western as well as Eastern Africa. How significant is that in as far as the operations of the corporation across the continent?
I think it's simply part of the their growth prospects. It just shows what they've been undertaking over the past few years. They wanted to explore more growth opportunity, and they're feathering themselves up beyond the core Southern African market. So I think it just falls within the broader strategy of the group to expand through either acquisition or organic growth. But essentially, they've recently gone into Ethiopia, which is promising. The economy there is rebounding, and so it might be a good area of focus going forward.
Okay, now back to SeedCo Zimbabwe. They of course now have 26% in this corporation. How do they stand to benefit should this corporation actually yield positives going forward?
It's a diversification for Zimbabwe, for the local shareholders who are on the shareholder list, the local shareholder list. Why? Because they have a stake in all the countries that the regional group is investing into. So they seek to benefit if those ventures become profitable or they return good money. So I think it's a good thing for Zimbabwe. The economics of this country is not going on okay, and government is the largest customer of SeedCo, and there has been issues to do with treasury bills, and those treasury bills now being affected by inflation and so forth. And basically, they are also, it's also a diversification from Southern Africa, which lately has not had some good weather patterns. It's expected that we might see an extended El Nino in the current 2019 to 20 season. So all those challenges can be mitigated, or it can be diversified by further investing beyond the Southern African region. So that's exactly what SeedCo is doing, going further north and also further east as well. So I think it's quite good for the Zimbabwean shareholders as well.
Moving on to Natfoods, they've increased their hectareage for contract farming from 4,400 in 2015 to 10,400 hectares in 2018. How relevant is that to the operations of Natfoods going forward?
So this is not a CSR move. It's not corporate social responsibility. Okay. This is a tactical move to control the value chain, and not just to control the value chain. They want to find a way around the lack of supplies. They have been failing to access enough forex to import their wheat requirements, the soybean requirements to process oil, wheat for bread, and so forth. So they are into the milling side of the business, and so they literally had to rely mainly on foreign sourced imports to feed into their milling operations. So there has been that serious backlog. Why? Because government has been failing to give them money. So it is out of necessity. It is a creative way of finding a solution to the current challenges that the economy is facing. And for them, it's actually beneficial to control the value chain by investing into a section of the market which they could control. How? They could obviously fund farmers. They could also facilitate in advising the farmers through various measures. There's been some models already that can be tapped into to ensure that better yields can be achieved. So the biggest problem with some of these crops is that their yields have not been adequate enough to make it profitable for one to get into farming some of these crops. So when such players come on board, they can obviously facilitate the funding side, as well as to also educate farmers on how to best increase their yields. So I think it's a tactical move, and they are not the only ones who are doing that. Most of the players, mainly in cooking oil space, they have actually been investing in value chains. Guys who are also into milling, they've also been investing in down the value chain. And I think that's a wise thing to do for the economy. Suffice to say, it comes at a net positive in terms of cost, to say maybe the cost shouldn't be greater than the cost of importing. If that's the case, then I think they should be on the right side.
We have a cyclone Idai, that has affected Zimbabwe, and at the same time we have the El Nino effect, which has affected agricultural produce over the past agricultural season. How much of an impact would that have on their contract business and ultimately where the group is concerned?
Definitely yields are going to be low. Why? Because obviously the El Nino is going to have a negative impact of reducing volumes from much of this contract farming. But I think generally as a group, they also seek to benefit from the El Nino in the maize milling side. But in terms of their wheat milling side, it's not going to be as good because it reduces what they were going to be getting from their contract farmers, which means also resorting back again to imported product. And the imported product is now coming at a cost of 2-point-something times. I mean, that is in line with the exchange rate. So it's a mixed bag. But I think generally the best way to push on the milling side, it's always important to finance farmers through contract farming.
Okay, I want us to have a look at another cyclone here, which is cyclone job loss, which is coming from down south. Standard Bank Africa has moved into South Africa, and they've just cut jobs, cut branches, shutting down 91 branches, 1,200 jobs cut in there. That's on the cyclone aspect of things. Before we get onto the significance of the finances, do you think that cyclone could actually move upward into Zimbabwe?
For us to have a proper evaluation of that, I think we need to probably try to dig into some of the causes. Why are they doing so? I think that can inform what we call a group strategy. So
take it away.
The Standard Bank South Africa is actually one of the key subsidiaries of Standard Bank Group, which is the holding company invested in all these countries. So South Africa is the biggest market, and whenever they want to introduce some of these key products, or they have whenever they have a strategy in some way, they first implement it in the key market. And so the basic direction the bank is taking is a digitization strategy or tactic. So they want to invest more in the digital space. I think I looked at some of the statistics. You see that they've reduced interaction between customers and real personnel within the employees. But there's also been an increased interaction between customers and digital platforms. So that really shows you where value is. So They have now decided to turn the bank into a totally digital bank. So they want to now scale down in terms of branch levels and also in terms of manpower manning those branches. And if you're then looking at what that means, it means that's likely to also come into other economies. Whether it's coming to Zim or not, I think it's only a matter of time. Why? Because sometimes you have to look at the level at which a level of maturity or a level of adoption or adaptation to technology in terms of different markets. So different markets are different levels of adaptation to technology. There are some which have adapted fast. You have to measure using mobile phone penetration, internet penetration. those are some of the things that show you whether an economy is ready for such a hurricane. So obviously South Africa is the most industrialized economy in Africa, is quite ready for such. And the numbers in Zimbabwe are also very positive. When you're looking at how over the past 3 years the central bank together with other banking institutions have moved the aspect of digitization, the aspect of pushing people towards utilizing
mobile platforms.
Yes, mobile platforms. It's been phenomenal. The growth numbers, especially coming from EcoCash, they can show you that we are a ready market. And this has also been pushed by the lack of real notes and coins in the economy. So there's been that cash crisis which has pushed the economy to become highly digital, and we are utilizing those platforms even better than South Africa itself. So we might see a reduction in the number of branch levels in Zimbabwe as well, from that 20 level, and even as well the
employment figures from 650.
Yeah, it's expected as a strategy in 2019 to 2020. That's what I expect. So yeah, the hurricane might indeed be coming, but it's a matter of time.
Okay, and then obviously that would spell some positives where the revenue is concerned, possibly, because I'm saying look at Kenya with M-Pesa, how the model is a tried and tested model, and so perhaps they need to do a little bit of refurbishments and maybe customize it to certain markets so as to derive value out of it and drive revenue up.
Definitely. I think that basically sums it in terms of how they have to approach it. Specific markets have specific needs, and they have different competitions, and so if you look at Zim, there's the issue to do with EcoCash, that is the mobile money side. You have to look at how competition coming from the mobile end is likely to also impact even your own growth prospects if you're planning to further your footprint into that space, or even the synergies and so forth. So they depend. It's dependent with different markets. So I think that's the approach which they're going to take. But there definitely synergies, as well as obviously some other forces like competition that they might fail to beat. But I think this has been the case for the local industry, the banking sector industry lately. There has been a lot of movement towards digitization.
Recently, Patrice Motsepe's organization launched what is known as the Time Bank down in South Africa, which is a purely digital form of banking, where they're extending loans as well as helping people open accounts so as to move into that digital banking space. So I think it's set to be something quite exciting on the continent, especially in South Africa, which would, I think, be very much critical in determining the direction that this particular program would take in that regard.
Yeah, so looking at Zimbabwe, I think Stewart Bank, which is one of now the top banked, the bank with the largest number of customers, has also been so active on the digital space. In terms of the impact and whatnot, I haven't measured the depth of their impact, but they have been very active in that space. Very often they have introduced some new products within their digital platform, with the recent one being the social loza, where from your WhatsApp you can actually open a bank account. You can have bots response. Using your mobile phone and whatnot. So I think some of these initiatives are likely to spare such revolutions across industries, and basically the banking sector is right at the top. And obviously there are also other banks with different products. FBC is undertaking a complete digitization of the bank. If you look at most of the banks, they obviously operate an internet banking. They operate they have got applications. I think 3 over 4 of the players have, and they've also increased the usage of POS and some other digital products that they are all packaging. So everyone is now focused on that end of things to say what opportunities are there, how do we increase our appeal to the user, because that's where people are going. I mean, people are spending much of their time on mobile phones, on on their television screens, which are digital and so forth. So they want to meet the customer where the customer spends much of the time, and that obviously enhances as well the usage of their own products. So such a move is critical in determining the direction towards which Stanbic will take in line with Standard Bank's group's strategy.
Well, thank you, Respect, for the insights. Thank you so much for watching. Stay tuned for Money Markets with Anis. Good evening, Anis. Welcome to the show.
Thank you, Eben. How are you doing today?
I'm good, Anis. Yourself?
I'm all right. All right. I know, same question. What are the markets like? Well, before we get into what happened today, I'm just going to give you a small recap of what happened throughout the week. Last week, we had about 35 counters that traded on the stock market, where you'll find your Hippo was the best performing counter, actually leading the pack of bears of about 7 rises. And then we had Zimpabwe's being the weakest performer of the week. Old Mutual was leading the pack in terms of value traded in that week, as well as Econet actually leading the pack in terms of volumes traded. Now, the stock market was down for the 3rd week consecutively. Well, this has some sentiment to do with a lot of investors looking for some liquidity now, since they had shored up most of their monies in the equities market when they were anticipating a very hard landing around about the time where the MPS was supposed to be issued. So, as of late, investors are pretty much moving out of equities harbor for them to actually find some other place for them to actually trade, especially the interbank market. But then as time goes on, we shouldn't expect much from the interbank market because of some irregularities that are showing some kind of manipulation in that market. But then
onto the stock market.
Onto the stock market for the day, actually. For the day, the board is very red, coming off 3.78 and 3.82% for the all-share index and the industrials index. For both of those indices actually to settle at 128.67 and 428.93. The top 10 index, once the hard hit one, coming off about 5.13%, for it to settle at 121.94 points. Well, that was pretty much courtesy of an Econet drop of about 12.74% to 110 cents, to 110.39 cents actually, and then Cassava and SeedCo International Limited trailed those losses by coming off 8.54% and 8.23% in an irrespective order for Cassava to settle at 115.02 cents and SeedCo International Limited to settle at 150 cents. Well, Padenga being the only counter that was trading in the positive today, almost coming up by 1%, just shy of 0.01% for its year-to-date lead to be ahead by about 10.59% at 94 cents. Now, our 5-day trend pretty much shows us a very weak stock market where you would find the sharp dive right there being much of today's activities, widening the gap by about 5.07% for the all-share index, while the industrials index has a wider gap by about 5.09%. The top 10 index is down 7.04%, while the mining's index has sort of sent down their negative trend right there to 1.9%, pretty much mostly because of how stagnant it has been for the past couple of 4 sessions actually now. So as we just look at our rises and fallers for the day, Hippo actually was extending on its prior week gains, coming up 7.45% for it to settle at 155 cents, while Econet, like we mentioned earlier on, was on the other end of the stick, coming off 12.74%, while OK and Art pretty much curved the fallers set, coming off 5.26% and 3.85% in an irrespective order for Art to settle at 9 cents and OK at 25 cents. Well, that's pretty much for me at the stock market today. Oh, sorry, before I go, we just talk about the forex market. Actually, the forex market does spell another day for the interbank market, where it has weakened in favor of the US dollar, meaning that we have come from a position of about trading at about 2.75 to 2.76, while the parallel market is trading at 3.66 versus a prior trade rate of about 3.65. Now the old mutual implied rate has pretty much strengthened there a little bit, coming to about 3.79 from 3.83, much to do with how old mutual actually performed today on the stock market. It was in the negative, and that's it for me and the stock market.
Well, thank you, Anesu, for the insight. Thank you, viewers, for watching. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our website www.equityaccess.net. A donkey and good evening.